Welcome to the Driven to Succeed Real Estate Podcast. I'm your host, Brandon Olson. And today I have a guest that goes back a long time since the beginning of me getting into mortgage, Rick Wenner from Credilife,
Thanks, Brandon.
a FICO certified coach.
FICO certified credit coach. Yeah.
Credit coach.
Yep.
Yes.
We met back when you started,
Yes.
and I was just leaving loan origination in 2008, somewhere in there. So yeah, no, things come full circle. Glad to be here.
Yeah. Known you over the years. You've helped plenty of clients of mine. And, and what I loved about you guys, and, obviously I've met tons of credit people and, and across, that, okay, yeah, we'll write some letters, send some things in. But tell me what credit coach means to everybody out there. Like, what is a good credit coach? Like, what is your guys' business model? And this
Well,
is really
the biggest thing is we have to take a holistic approach. And what I mean by that is Jared and most of the principal people that make up our coaching team have been loan originators. We understand how hard it is to get a file together, to get someone to take the steps necessary to put themselves in a position to be qualified for a mortgage.
right.
So we know what the steps are, what order they need to take, and by the way, motivate our clients to know why. A lot of what's happening right now is available online. Everybody knows, what to do, how to do it, but why am I doing this?
Right.
Right? It's to put yourself in the best possible position to be pre-qualified for a mortgage. So the coaching and the consulting is all the magic. I mean, if people said, what's the magic in being a coach? It's sitting down and coaching my clients, answering their questions, listening to their concerns. At
Right.
the end of the day, and I may have mentioned this to you a few times, I've certainly mentioned it to your clients. My job is to not only transform your credit report, it's to transform your relationship with your money.
Well, and that is 100% what needs to happen, right? We've talked about this, and like some people, without that coaching, they may get their score up, and 12 months later, they're right back where they were. They
Right.
never changed anything, right?
Yeah. Right.
And part of that is, and I tell people, I give tips all the time. I've done this a long time, so I know how things really work. And like, here, this is what we can do. And if I can do it on a level that's right here, right?
Mhm.
Not up here, right?
Mhm.
But I can do it down here where it's like, hey, we got these few things that we can do. We can bounce your score to get a 720 or to get it to, 30, 40 points. But, taking somebody that's much lower and that's had way longer credit history is way out of my realm,
Mhm.
right?
Yeah.
And that's where I rely on people like you.
Yeah.
But also going back and like, you really dive into that education of the money aspect,
The
and
money, the family, the goal. I mean, most people who want to buy a home, they want a backyard for their kids to play in. So that's a conversation I can afford to have. Whereas when you're putting together and originating a loan, you're looking at a close. There's no close in my business. It's a
right,
marathon.
right,
What can you do to change your relationship with money, your budget, couple how they can change their relationship with each other
right,
to get these behaviors to the point where it's sustainable. You're going to have to make that mortgage payment for 7 to 15 years.
right,
Let's get to work.
right. And what also it does when you really start to take into effect, like, when I'm trying to refer somebody over and like, just like, hey, listen, like I can, maybe you are a 605 and I can get your loan done right now, but when's your lease up?
Mhm.
Can we get that to a 640? And what is a 640 score going to do versus 605? Well, the loan cost for mortgage is huge, but also it starts to play into everything else. And you get that, and we're just talking about this game theory, right?
Right.
If you can start really, really thinking of it that way and getting that, and all of a sudden your credit card interest rates are coming down. And next time you buy the car, you're getting the best rate there.
Yeah.
I came from the car industry and, running 23% interest was no problem,
Mhm.
right? And you're just looking at these payments and you're like, oh my God, 23% interest on a $15,000 car. And you just put 5 grand down. This $10,000 car is going to cost you 22 grand.
Right. Yep. Yep. Oh, for sure. I mean, one of the questions I learned when I was transitioning from loan origination to being a credit coach is asking those questions. Hey, Brandon, what are you paying on, what's your interest rate on that F-150? And they blow their head and they're like, oh, I'm paying 11% on it.
Right.
I now need to discover what's the cause of that? how did all this get to this point, and really unravel that. And it usually comes down to budget, changing behavior, communicating. Most people, when I started in banking, I worked as a teller. you know, People rely on their bank to do so many things, and they rely on their agent, they rely on their loan officer to do so many things. No, get control of this. It's your credit.
Mm-hmm.
You need to be the one that's balancing your checkbook.
Right.
I talk to people all the time. For example, how do you manage your balance in your checking account? 65% of Minnesotans balance their checkbook at their ATM machine.
Right. Right.
You sit down and you look at their bank statements, you start asking them these questions, and obviously they're embarrassed and they feel,
Mm-hmm.
self-conscious about it. But that's because when I was a loan originator, I hated it, Brandon.
Right.
I hated giving someone a denial letter.
Right.
I put in the work. I knew they were showing up for work 50 hours a week in their
Yeah.
F-150, and they were still getting quoted either a ridiculous interest rate or getting denied access to the funds. So being a coach allows me to go full circle with them. And oh, by the way, I can be objective. I don't have the pressure of me needing to perform.
Right.
I can say, hey, you know what? I get it. Your lease ends in June. Let's circle back to Brandon in September. You'll be in a better position then
Right.
anyway.
Right.
So, I don't have that pressure to
Right. Close this right now.
close
Right.
this deal right now.
Right.
Right. Exactly.
Yeah. I get I get some times where I have, an agent will call me and like, hey, they got denied by this lender. We want to put an offer on this house. And I'm like, dude, hold on. Let's take a look at this. And it's like timeout. Let's slow it down and do what's the best benefit of this buyer, right?
Yeah.
Like it is crazy sometimes. And I've done enough transactions where I really can help those people, but if we're just moving that fast just to get them in the house, is it always at the best benefit,
Right.
right?
Well, and I look at, I work now, and we'll talk a little bit later about some of the business credit pieces I'm doing. But even in some of my own investments, I've realized, and certainly working with brokers and other people that are doing real estate investing, REI investors, financial wellness also means the ability to say no.
Right,
If you're walking around with that pre-qualification letter and you've pre-qualified me for a home,
right,
I can walk onto a home, go to a home, open house, and I can say, no, this isn't the right fit.
right,
And I'm sure in your career, Brandon, you've looked back and you've gotten people pre-qualified and you're thinking, I hope they realize they can say no.
right.
They don't have to buy, and you work from the car industry. How many times in your life, Brandon, have you bought a car because you could afford it? It wasn't the best fit.
I
Right?
can tell you firsthand from that I've really, really thought about doing this too, is writing I've actually put a little bit of time into it. Trade secrets, full disclosure of the car industry,
Yeah.
right?
Yeah.
Like this is, how many times I had one of my coworkers, another finance guy, right? We got this lady approved on a car and the payment was like $850. And this is like 2013, right? Now $850 for a car payment is like, oh yeah, no problem, right? That's
Yeah.
what like the average car payment right now is like $900. It's
Mm.
crazy. But back then, I mean that was like double. And she literally tells him, I'll try it for a little while. Like, and and you hear that and you're like, oh my God. But, we as finance people, all we can do is, hey, we got it done,
Yeah.
present it to you and you can take it.
Yep.
Right.
Yep.
So, with that, it's just that there's times where, I'm like, hey, is your wife going to be working at this new location? And like, you don't want to see people like foreclose on a home. That's the
No.
last thing, and then it goes on, like, okay, it was a loan originator. That's what foreclosed. And, most mortgage companies don't tell their employees like what closed and, what foreclosed. And, unless you all of a sudden start having like this big string of foreclosures. Okay, what's going on with this guy?
Right.
Right.
Exactly. Yeah.
Why do they have this and so forth. And, fortunately, I've never made that list, so
Yeah. Yeah.
that's a good
Well, I
thing.
did hear some news though that is it Rocket Mortgage? They're finally getting what the karma's coming around a little bit. But yeah, that's my point. There's a big difference between affordability and financial wellness.
Right.
And that's what I've experienced from you, right? And
Hmm.
the loan officers I partner with is making sure that it has to be affordable, but it
Hmm.
also has to let stand the test of time. It can't just be a 640 credit score at the time you close.
Right.
It needs to be a lifestyle, and that's why we call the company Credilife. It has to be a lifestyle of understanding that at any point in your life, you might need a new car. Well, by the way, you might finance this new house and you now need to go out and buy a washer and dryer. You might need to finance that washer and dryer at Sears and all the things that, go along with being a homeowner, having that financial wellness.
Yeah, it is pretty good because the nice thing now I've come into where I financed their first home and now I'm financing their second home. And their first home we were FHA,
Yeah.
but they've been through, coaching like yours.
Yep.
And now we're going conventional and their lifestyle has 100% changed,
Right.
and they're the happiest homeowners
Right.
ever, right?
Yep.
Their net worth have literally gone up like three, four fold, and their credit scores we're not that 660 score anymore. Hey, I'm at a 730 or I'm at an 800, right?
Right.
And they're just proud, and that is accomplishment. And people grow up. You grow out of those old habits and those old lifestyles and making sure that you're not necessarily trying to keep up with the Joneses per se.
Keep
But
up with the Joneses. Plus, you're also, I'm starting to realize that people realize it's an asset.
right.
Having buying power,
Hmm.
having the ability to sell, to list a home. Right now, I know my agents, the agents I'm working with, are struggling to find listings.
Right.
Well, do you know how many people there are in my age group, 50 to 60 years old, sitting on $150,000 in equity that can't afford to sell and rebuy because their credit is bad?
Right.
They can't bluebird to Arizona.
Right.
Their credit score is a 600. It doesn't matter they have $150,000 in equity. They
Right.
don't see a path to getting to Arizona.
Yeah.
And a program like ours and showing up to the gym, the financial wellness gym with myself or my coaches, that's going to get you there.
Right. And or feeling like I have to work my entire life,
Right.
right?
Yep.
And that's just the nature of some people's mindsets where, like, oh, if I would have just did this 10 years ago, right? Or
Yep.
5 years ago, even,
Right. Right.
right?
Yep.
And it's never too soon to start really making that change,
No.
right?
No.
And it's that is just that, that coaching that's what with when I sat down and saw you guys' program and, when I'd talk to people and I'd hear, and but I probably shouldn't say this too loud, but the Lexington laws of the world, man.
Yeah.
Every time I hear that, it just makes me cringe. And I'm like, what did they do for you? How long have you been at? I've been in it for a year. And I'm like, oh my God,
Yeah.
you just spent $1,400 or fifteen hundred
Yeah.
dollars or more for the last year, and your score is still there, right? Yeah,
Mm-hmm.
and nothing's changed.
Nothing's changed. You're light $135 more a month.
Right.
They haven't communicated with you. And oh, by the way, your real estate agent may have been the one that referred you to him, right? It's the same thing. I talk about this too a lot with coaching. It's the same thing with people who think they can buy and sell or finance a house on their own. You can do it. That doesn't mean you should. Your previous guest, there's a lot of value in working with an agent, a ton of value.
Right.
And to me, in having invested and bought my own single family homes and now in investing, it's that ability to say no.
Right.
It's that ability for a loan officer to say, maybe we wait,
Right.
or maybe we get this FHA now in 7 years, like you said, circle back to me when you've got an equity position
Hmm.
and either refinance or sell or list. Or how about this? Rent that place out. You've now got the financial wellness. You have more options.
Right. I'm struggling right now because I have a client that, has this budget in her mind and I have the budget that she can, right? And I'm just like, don't, like, I can get you this, but I personally, we're going to be in a much better position in about 4 or 5 years if you just, you know, and then I get a call from the agent and I get I was like, hey, we're looking at this house. And I'm like, oh my God, I don't think it works. I'm like, and it's a struggle because they're trying to build a house, right? Or like buy a new construction and it's like, yeah, your payment's going to be lower because we don't have the full escrows of taxes, right? And so forth. And it's just like if we can just start on the ground level, let's not go this high. Let's
Yeah.
keep it here. And in 10 years, 5 years from now, even, you're going to be in a
Much better
way,
spot.
yeah.
Yeah.
And look how fast things change in the next 5 years. The new style of cabinets are going to be out and like
Yep.
whatever else.
Yep.
If you do it this way, you can get that
Or
next.
different creative financing. I mean,
Right.
I was talking to a lender the other day. They were talking about Um, I don't even know what it is, but it's kind of like the reverse mortgage, but it's not. But I mean, those types of products are on the horizon. You guys are probably working on them right now, where a different way of relating to money and
Mm-hmm.
to growth in general. I read a stat too the other day, and this is kind of pointed at any young people listening that, oh, I don't want to buy.
Right.
You know, I want to rent, or my career might move me to Silicon Valley or New York or wherever. I read a stat that said in the last 60 years, a homeowner that's held their position for 10 years has always gained equity except for one out of those
Right.
60 years. And
Right.
that was 2006 when
Right.
nobody was making money.
Mm-hmm.
That's amazing.
Right.
And I'm an economist by trade. That's what I went to school for. That means that of all Bitcoin, um,
Right.
Apple computer stock
Right.
that I own, all of it, none of it was as profitable as investing in your own credit,
Yep.
your financial wellness, and real estate.
Right.
It's just
None
a
of it.
fact.
No. Yeah, and I've said this numerous times. I tell people this all the time. You're like, well, I'm gonna wait till rates come down. And or specifically, I think people have really come to the fact that we're not gonna see a big crash unless we have some major things
Mm.
really happen, right? Like, oh, it's just, they're way too overpriced. I'm like, do you understand why we're overpriced? It's not like it was in 2007,
No.
2006, where we had 30,000 homes on the market, in the Twin Metro area, it was 23,000. And then foreclosures happened and he added 10,000 more. Well, you already had a 4 or 5 month supply.
Yeah.
And now you added this, and now nobody's buying, and it just, that it was the crash, right?
Right.
Now it's different. I mean, we're 7,000 homes in the metro market, right? And that's why the offers, like in December and November, December, I'm like, that's the time if you want to get sellers to pay closing costs and do
Yeah.
everything else. And you can still get that, but periodically out the year. But generally, that's about the only time,
Yeah.
right? We're in this environment. And Keller Williams predicted we're 18 years before. If we started building at 2020 levels, we're going to be 18 years before we
And
can get
stopped
up through
having any
that.
more children that never buy.
Yeah.
Oh yeah.
Right.
Well, my first home that I was blessed. I graduated from college with a degree in economics, and my first thing I wanted to do was invest in real estate.
Hmm.
And I was, student loans weren't an issue, so I had those paid off. But my first mortgage in 1993 was 9.125.
Right.
Other than when someone tells me they don't want to buy a house, I never tell that story
Right.
because it didn't matter. I still made
Right.
equity.
Right. Exactly. Now, speaking of young people and speaking of economics and what I've seen and what a lot of people have done, and now there's so many more ways to become self-employed, right?
Absolutely.
And let's talk a little bit about your business credit. Now, your
Yeah.
guys' new venture that you're going on.
Yeah.
Like, I need to know more about this,
Yes.
right? Like
Yeah.
100%. So let's
So
get into that.
it's all come up out of demand, organic demand from our clients. So 5 years ago, one out of every five of our clients was going into COVID with with credit issues, compromised credit. And during COVID, realized that I need a side hustle. I'm either not an essential. I love that how corporate America said we were non-essential employees, or some
Right.
of us were.
Right.
So they realized they were non-essential employees. So they had to go create a side hustle or a career
Hmm.
themselves. And it started impacting how creditable they were, how bankable they were. And so we spent out a whole new service offering around coaching and some technical pieces based upon how to take a business from scratch or 5 or 6 years into it and make it bankable, how to access financing, how to secure capital, and how to appropriate those funds to grow your business, how to open up a podcast studio, how to, hire an engineer to help do these things, right? So all that requires capital, but more importantly, it requires intention. You need to intentionally take the steps to build out that business credit profile. And yes, just like there is on personal credit, there's a score called the Dun and Bradstreet score, which I'm sure you're familiar with, that banks and investors look at to determine the risk of lending you $5,000 or $500,000 for your business. And
Right.
so in a 6 month period, you hire me as your chief financial coach, right? I become your CFO for 6 months, and I'm intentionally working with you side by side to intentionally make you bankable in a 90-day period, a 6 month period, and then 12 months from now, if you're looking to buy, property, right? A lot of Small businesses are looking to buy a property. I'm working with a guy in Rochester who's buying a garage to keep his
Hmm.
dump trucks and his skid loaders in.
Sure.
He's buying real estate. So
Right.
for us, it was a natural transition, natural conversation with our clients.
Right.
1 out of 5 of them were in a position to go out, hang out their own shingle, start their own business.
That's awesome. That's what, as a business owner myself, and as I've, you know, got raised funds to build a tech company, and it takes a lot of money, and you can burn through it. And you read all the books, and you start here, and you start looking, and you're like, what's your burn rate? Like, and you get an investor that just gives you 150 grand, and you're like, that's like 4 months, and that's if I'm conservative,
Hmm.
right?
Yep.
You know, it's amazing how fast, and then you know, we
And you're a person
literally,
where the numbers don't scare you in general anyway. Yeah, no, I get it.
yeah, and then you're looking at like, you're like, okay, well, if I do this or do this, and it's like, you talk to a VC, and they're like, well, what does it take to get everybody to go full time? And you put the numbers together, and it's scary. You're
Mm.
like, holy hell. And that's what many people don't have, an idea when they're starting a business. They don't understand it at all. And I've read, I definitely got all of my education in the last few years versus college,
Yeah.
because it's all been self-taught
Yep.
and going to the right people
Yeah.
and understanding this. And you still don't know until you get into it. And you
Right.
still don't realize it until you
Right.
get into it,
Yep.
right?
Well, there's 3 ways to grow your business. And the best companies, the most successful over a long period of time, let's say 10 years, are going to leverage all 3 areas. One, sales and revenue. I mean, let's face it, that's why we're talking today, promoting our business and doing what we're doing. Revenue. Second is sourcing things through growth and acquisition, hiring employees, like you mentioned. How do you bring these people on full time? Buying out your competitors, buying ideas from your competitors. And the third is other people's money.
Hmm.
And I'm 56, and it took me a while, but not very long to figure out that I need other people's money.
Right.
And I had done it all along. I mean, I was helping people buy houses with
Other
other
people's
people's
money.
money. So, again, to the younger people who are out there going, oh, I don't want to use other people's money. I'll tell you right now, Donald Trump and Elon Musk used other people's
People's
money,
money.
their dad, to do what they're doing. And
100%.
to me, it's just a simple economic step you need to take. And oh, by the way, companies that go public, knock on wood, maybe your software goes public someday and you need to borrow or raise $200 million. Guess where you're going to do that? Shares
Mm.
with other people's
People's money.
money.
Right.
So that's what I'm trying to teach these
Right.
businesses is you can still work 60 hours a week. You can still build a legacy for your family and your friends. But consider the fact that you have the opportunity to build your business credit profile, access the cash, the financing, secure that capital, and grow your business. Now, what you also don't want is you mentioned VCs. You don't want um, the guys in the Shark Tank like Mark Cuban and Kevin O'Leary. You don't want them writing out checks because they're going to want 51% of your company to do it.
Hmm.
So the biz credit way, the way we're doing it through the business platinum program is how do you borrow other people's money to pay them back so that they'll lend you more? And we get into rounds of funding, just like you do with FHA to conventional. We do the same thing with business funding.
Right.
Get that seed money, get maybe $20,000, $30,000 to put a website up, get American Express, get a fuel card. 6 months into it, we've got accounts receivables. We're leveraging accounts receivables. Investors, some investors that have owned property for 20, 30 years aren't taking rent money in to get the accounts receivables they need for that second round of funding or to refinance that commercial real estate property.
Right.
And then that third piece is, software or investing in something else that really is a bigger ticket item that you need to finance. Because let's face it, gone are the days where you have as a business $2 million sitting in a savings account making 7%.
Right.
It's sitting at Wells Fargo. It's sitting at a credit union. It's sitting somewhere
Well,
where
they're making the money off of
they're
it.
making the money off of it. And connecting the dots for how our clients can do that. How can
Right.
you borrow other people's money, pay them back, continue to feed that, right? And by the way, and this is the lesson I learned, you can borrow it at 4 to 7%.
Hmm.
How many times have you seen a credit report where an investor was investing in real estate on their own personal credit when it should have been their business credit that was buying that house
Right.
or that laundromat?
Right. So that's even on my side, understanding it from that point of view, right? Um, and all the roads that I've gone down, took me a long time to get to there,
Yeah.
you know. And well, we're still at basic revenue, basic MVP as we're building, and we're talking to VCs, and on my side, we're getting this we go through angel,
Yep.
right? So we've done mostly angel, and we weren't trying to raise as much as what now we're looking at.
Right.
um and it is different because now you got to understand, okay, you're getting into when you bring up Shark Tank, how many people over the last 5 years said you should be on Shark Tank, right? And no, absolutely not, right?
Oh,
No, I
gosh.
don't want to be on Shark Tank. um it's funny, one of the VCs we're talking to literally is part of that, but we're not on it, right? And
Yeah.
we just found out that literally after we had did a demo with them and whatnot. And we have another coming up meeting in a couple of weeks. Anyway, long story short, it's just understanding, specifically, you get in that environment, they are going to take that because
Yeah.
they want that, right?
They want
If
the guarantee.
if you can grow, the tech world, it's a little different than just if you're, doing a construction company, right?
Right.
Or something else. So there's different avenues for different industries.
Absolutely.
But at the same time, when you do get to where we do have full revenue, that's when we do want to look at the business credit and not
Right.
taking additional,
Right.
you know,
Well, the other thing I
funds.
found before my career in financing, I worked at Apple.
All right.
I was part of Apple Computers IPO for their financial wellness pieces and components they were doing with software. The other thing that having strong business credit allows you to do is spin off a child company, right? Like think future. Think if in 5 years the CRM, there's some sort of app, I don't know, throw it out there like Credit Karma. I mean, that's what Capital One
Right.
did. They just threw together this thing called Credit Karma because it was just this little side things a bunch of tech geeks had put together, and it's an awesome product.
Right.
They just spun off a whole separate LLC, limiting the liability of that corporation from that parent entity.
Right.
A lot of people don't understand that the idea of having a limited liability corporation is so that Brandon's not taking money out of his personal checking and savings account
Right.
and putting it into his business. Those two things need to be separated. And so a lot of what we're teaching entrepreneurs that have been in business for a decade is, hey, you need to go through a divorce. Like you
Right.
need to separate these things
Right.
because you can't keep managing, balancing your checkbook at the ATM and at the same time expecting your business to grow.
Right.
This being a lender on the mortgage side, personal finance side, there's a ceiling to how much borrow money that a bank's going to lend you,
Right.
right?
100%.
There's a ceiling, right? Whatever that ceiling is, it's a ceiling. And all the risk from their back is mitigated by credit score, dispositioning, all the documents, putting together the whole loan package. On the business side, it's completely the opposite. There is no ceiling. The risk is literally how much time and money do you want to put into this, and how much money can you reinvest in the business,
Right.
right? I tell people this all the time. I'd ask you this right now. If I could put you in a position where I could find one of the 1,400 national lenders, investors that I work with, if they were to write you out a check for $1 million today, what would you invest it in? That's what I'm coaching my clients on. It's not how can I be more profitable. I know you know how to be profitable. That's
Right.
why we're having this conversation. You're successful. It's how do I access the financing, secure the capital to grow the business, not just to sustain the business, not just to pay employees or advertising, to grow the business.
That money is meant to do the 10x return, right?
The 10x growth return, 100%. Thanks for asking that. But yeah, you have to take this, you have to walk before you can run.
100%, right?
Yeah, because the dollars get to the point where the decisions you're making, the yes or no decisions you make as an executive of your own company, they're unforgiving.
Right. Right.
There isn't, unless you have me tagging along with you as a CFO for 6 months, there's no one to say, don't do it or do it. Right.
Right.
It's money and it doesn't care.
Right.
It's
Mhm.
going to get spent. That's the other one thing too that I would mention to the listeners is, unlike on the personal credit side where there's a finite amount of money to lend, right? Like even your business, there's only X amount of dollars you guys are going to lend out this year.
Right.
You have to mitigate who you're going to lend it to and who you're not only to protect yourselves, but to protect the borrower
Right.
and the investor. On the business side, that's not the way it is. There's literally almost an infinite amount of money available sitting on the sidelines right now in 2024 that companies can borrow. And oh, by the way, the tax mitigation and the tax code on the business side is all intended for business growth.
Right. I was just talking to a real estate investor the other day, and I mean, he's gone. I had him on the show a few months ago, Mike Mitchell, Mitchell Realty. So he's got his broker's license,
Mm-hmm.
but he's gotten, he flipped homes and he did this and he did that, right? And he started hammer and nails, right? He was the one flipping the homes, right?
Yep.
Eventually, now he just has crews that come in and do it. Now he stopped flipping homes and now he just does massive real estate transactions, right?
Mm-hmm.
So he had talked about he bought 20 homes, I believe, um, just by, you know, going around like just word of mouth, like, hey, who do you know? Who do you know? Right. And all of a sudden, hey, this guy, he just passed away. His partner wants to part with these 20 homes. So he put a package together, went and did it. How did he get there? Right. He started with a business partner. And then from that point on, he, started using credit like what you did.
Mm-hmm.
Right.
Yeah.
And highly successful, works is, and I think he will say he's not successful. Right. That's his mindset, right? He's not successful. He's
More nails to pound in.
right. He's very successful. He's like, I was just this redneck dude, right? Or
Mm-hmm.
blue collar dude. I shouldn't say redneck, blue collar guy, right? Um, and his work ethic is huge. But he was talking to me. He's like, yeah, he's like, I talked to my, just this deal came up for 2 million bucks. So I just called my lender. I got this new bank now that I'm working with, and he's like, and I was talking to him. He's like, and I just asked him. He's like, dude, we need people to come and get money from us.
Yeah.
Talk about money sitting on the sideline. He's like, we have money for people. Like people are just not moving right now. Whether it's the rates, whether it's this, they think that, da 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 da, right? All these number of reasons. Like we have the money,
Yeah.
right? Now, again, it could be like Mar-a-Lago where they say, somebody thinks it's only worth 18 million when it's X.
Mm-hmm.
But due diligence, the bank is going to do the due diligence on
Yep.
whatever you're buying.
Yep.
And they're going to say, okay, yeah, this is a $500,000 commercial, site, whatever,
Mm-hmm.
blah, 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 right?
Yeah.
But the money is there.
Well, the
And
money's there. And the other thing I'm figuring out, and especially on Main Street, right, is the opportunity to invest in multi-purpose facilities. I mean, look at the facility we're sitting in. Somebody owns this building.
right,
There's 17, 18 small businesses operating in it,
right,
right? So there's opportunities for investors like that to also look at creative financing and accessing more capital to make their financial wellness for their clientels and their tenants better too. I mean, one of the things that we're working on right now is the supply chain of money, right? If I help a real estate broker that has a building in Lakeville, he has a title company, he has a lender there, he might have a Subway in that same facility.
right.
What does all that revolve around? Other people's money. Now, the investor, the guy sitting in the ivory tower with all this money sitting on the sidelines, he's still making money at 4 to 7% on Wall Street. But would he rather come back to you time and time again and say, here's 100,000, here's another 100,000? The answer is yes.
Right. Awesome.
Absolutely. Yeah, it's fun. And the other the most rewarding thing for me is I'm exercising all the lessons with my clients that I wish I'd have known when I was in my 20s and 30s.
Right. But no offense, man, you got the experience and the years behind and the knowledge and everything else. And this is why people come to you as a
Yeah.
professional
Right.
and look for your guidance and your help. And you
Yeah.
have that track record to show them.
Yeah.
Right. And I mean, you walk before you run every step of the way. Everything's a process. I tell everybody, all my employees, hey, it's a process, right? It's process, big process guy. And it eventually all of a sudden, wow, it's there, right?
It's there. And you are going to feel like you're not done, right? That's part of the day. I mean, I was arguing with somebody on Facebook this morning about like Michael Jordan or something. And you'd have to understand you're talking to someone who's 32 years old and never watched the Bulls play basketball. But you're like thinking in the back of your mind, you know how many times he lost a playoff game? He missed the stupid shot. But what did he keep doing? Kept putting up the shots. Like, don't stop.
Right.
Don't let COVID or don't let your uncle telling you, oh, go work for 3M stand in your way. Just If you want to start your own business and you're that type of guy that when you're driving down the road and you see a billboard, rather than thinking about how you can buy the product, you're the guy, you are Brandon, you want to be the guy on that billboard, then you need business credit.
Right.
Absolutely.
Awesome. Well, Rick, that's a 35 minutes of knowledge
Thanks.
and good information. We didn't get into tips or tricks, but that's why you are going to call him. So,
Yeah. Well, I post it every day on LinkedIn, direct message me. The best way to get a hold of me,
yep.
612-444-3808, or shoot me an email, rick@credilife.com. That's Credilife.com.
Right.
Yeah.
Awesome, Rick. Thank you for coming on the show.
Thanks for having me. I'm looking forward to coming back on.
Yeah, absolutely.
Absolutely.
Let's revisit in like next 6 months or so.
Absolutely. Absolutely.
Awesome. All right.
Thanks, Brandon.
Yep. Please like and subscribe. See you later.